Good evening, everybody. We're just waiting for one more minute and then we will start off. Thank you for coming to this AICLA organized talk on business interruption. Okay, it's 2 minutes past 4 o'clock, and good evening to everybody. Welcome to this session organized by AICLA International Division. We are happy to have with us the guest speaker from MDD, who will talk to us about 101 of business interruption insurance coverage. For the purpose of the formalities of the event, we like to invite the chairman of the International Division AICLA, Mr. Andrew Khoo, who is also Deputy CEO of MSM Insurance Loss Adjusters based in Malaysia, to give his introduction remarks. Mr. Andrew Khoo, over to you.
Thanks, Puba. First of all, welcome again, everybody, to this webinar 101 of BI insurance coverage, organized by the International Division of AICLA. So before we start, I would like to record some thanks to some parties and who have assisted in the in organizing this webinar. First of all, I must thank MII, the Malaysian Insurance Institute, and the Association of Malaysian Loss Adjusters, AMLA, for supporting this webinar and also circulating our brochure to all their members. I also like to record my thanks to Singapore Insurance Institute and then the General Insurance Association of Singapore for their assistance in circulating the brochure. So, is somebody...
Well, I'm going to mute all.
Okay.
Proceed, Andrew.
Okay. Then, of course, we must thank Pak Deli for kindly helping us to broadcast this or live stream this webinar via dkhairatTV. So I think after that, we will all be able to refresh our memories after the webinar if need be. And thank you, Puba and Talent Asia Training and Consulting for hosting this webinar and providing the logistics. Of course, many thanks to Kun Ne of MDD Singapore, or MDD, for agreeing to be the presenter and share experience and knowledge with everybody. As all are aware, Kun Ne have a vast experience in forensic accounting related to BI claims and adjustment, insurance claims and adjustment, and she has been engaged in many BI assignments throughout Asia. So even personally, we have also dealt with the company on many occasions. Last but not least, I would like to thank all participants for taking time off to participate in this webinar. I hope that everybody will be able to gain some knowledge and insight after this session on BI insurance coverage. And should you require any clarification, please send in your message via the Zoom system. And I'm very sure that Kun Ne will try to answer or clarify wherever necessary. And I think without further ado, we shall start rather than having insufficient time at the end of the day. So, ladies and gentlemen, thank you again for participating, and I hope you will enjoy this webinar. Back to you, Puba.
Yeah, thank you. Thank you, Andrew, for the introduction and the formality bit. I just want to remind all participants to kindly switch off their mic. Please mute your mic so that you don't disturb the presentation that will be done by Ms. Nay shortly. So you can please type in your comments on the chat and Ms. Nay will respond, but I think she's going to keep it for the end when we do the Q&A. She's got a very tight schedule to share with us some of the basic details about the business interruption insurance coverage. She will share with us her expertise. So allow me now to call upon Ms. Nay to proceed with her presentation. Over to you, Ms. Nay from MDD.
Thanks, Kuba and Andrew. So welcome everyone to today's sessions, 101 of BI insurance coverage. So we have a very international audience today from many countries like Malaysia, Singapore, Thailand, Cambodia, Indonesia, Vietnam, Maldives, to name a few. My name is Nay. I'm a manager at MDD, forensic accountants. I've been working at MDD for about 7 years. Previously to MDD, I worked for a forensic service department in one of the big 4 accounting firms, focusing on fraud investigation and insurance claim. Okay.
Nay, I'm going to switch off the mic again because there are some noise in the background. Then you have to unmute yourself.
Sure.
Yeah. Yes, proceed.
Okay. So let's take a look at what we are going to cover today. We're going to start with the definition of BI. Then I'm going to walk you through the calculation of gross profit, how we're going to calculate that. And then I'm going to walk you through the application of other circumstance clauses in BI calculation. Next, to why the sum insured should be set correctly and under insurance issue. Then there's going to be a simple BI loss calculation, example, so you can link theory to practice and how to apply each BI component in the calculation. There's going to be a Q&A sessions after the presentations. So you can send in questions, through the chat box or send me questions via email if you have any questions after today's seminar. So why do we do business? One of the main reasons is to make a profit out of it. But what if the incident happens? Definitely profitability will drop, and this is how BI policy comes into play. It will fill in the gap during the loss period. So this is the normal level of profitability the insurer can achieve. As you can see, I'm not so sure whether you can see the cursor, but you can see that it slowly decreases, assuming that the insurer has some inventory to continue its sales, for a period of time after the incident happens. But if there is no stock, you're going to see a sharp drop in profit. At this point of time, the insurer managed to restart the production and resume normal profitability. So BI policy covers a loss of profit that a business suffers following an incident. And the key word to that is to put the company back into the same position it would have been, but for the incident, meaning we can't compensate more or less than this chunk. This is the portion the insurer couldn't achieve during the loss period, and the BI policy is intended to compensate the insurer for this missing piece. For the BI policy to trigger, here is the chain rule. So what triggers the BI policy? There must be a physical damage, and it must cause some damage to all or part of described property, which might be buildings, plant, machinery. And it must be caused by an insured peril. Example, fire, flooding, earthquake, storm. And it must be indicated, sometimes it will be indicated in the policy whether, these costs are covered by the policy or not. It's quite important that we always check back to the policy because sometimes it might not be covered. For example, after 2011 Thai flood, loss due to flood is excluded from some of the policies or even capped at low sublimit. So it's very important to always, check back to the policy. And because of that, it must cause some necessary interruption of the operations, which results in a loss of business income or profit. If it causes an interruption but doesn't result in a loss of income or profit, then there is no BI claim. For example, if one of the production lines goes offline for 1 month, but the insurer managed to produce more at other production lines which have excess capacity, then there is no loss of profit sustained, and therefore no BI claim. And everything or the loss sustained must be within indemnity period. So if the loss extends beyond maximum indemnity period, then it's not covered. Indemnity period might be 6 months, 12 months, 18 months, 24 months. It all depends on the insurance policy. So always check back to the policy for how long is indemnity period. So if BI coverage is triggered, we will pay business the profit loss through to the point it's restored or when the maximum indemnity period expires. So if any loss sustained after maximum indemnity period, then it's not covered. Here is a graphic of the main components of a BI loss. This is what we look for when measuring a BI loss. We're going to start off by trying to estimate or project what we believe the turnover would have been, but for the damage. From that, we take away or deduct actual turnover achieved during the loss period to calculate the loss of turnover. Then it's multiplied by rate of gross profit to determine how much of the loss of turnover is actually a loss of gross profit. I'm going to explain to you later how we're going to calculate rate of gross profit. From there, we deduct any savings we are able to identify in fixed costs. And we add on to the measurement the economic portion of ICW. There might be some elements, a couple of things that we may deal with, including average adjustment and in additional increased cost of working. I would like to talk in more detail about the first component, standard turnover or projected turnover. This is an extract from one of the policy, just to give you an example, which refers to the turnover achieved 12 months before the incident date. There is an adjustment clause attached to it called other circumstance clauses. If you read it here, it actually provides for trend, variations, and other circumstances to be factored into estimating the level of turnover which should have been achieved but for the insured damage. By way of example, let me give you an example. Like if the insurer just launched a number of new manufacturing lines few months before the incident occurred, let's say 3 months. So revenue in the last 3 months, of course, went up significantly. It's therefore not appropriate to project the revenue based on revenue achieved 12 months before the incident date. We should base our projection on the last 3-month revenue figures. If you look at 12-month pre-loss figures, definitely the average will be too small, right? So we don't always just stick to the policy wording for standard turnover. Always look for this clause called other circumstance clauses, which allow us, to look at other factors which could have, affect the projected turnover during the loss period. This is an example of a business with seasonal trend with peak period in the middle of the year, which you can see in this chart, from May to July in each year. So if the loss period spans over the period May to July 2020, for example, we may want to project the turnover based on the turnover achieved during May to July in year 2018 or 19, rather than projecting it based on 12-month pre-loss, as average will be lower. One of the seasonal industry is hotel. So when we deal with hotel losses, we were gonna look at the business performance of the same loss month of previous years when we project turnover and rate of gross profit, as they are not the same during peak and off-peak seasons. So the loss of turnover is different, between, so now that you have the projected turnover, right, we're gonna calculate the loss of turnover by deducting actual turnover from projected turnover. Just to recap one more time about projected turnover. So the policy will state that the standard turnover is based on 12-month pre-loss, but it also have a clause attached to it called other circumstance clauses, which allow us, to project it based on other base period, which give us more flexibility, in coming up with the projected turnover that the insurer would have achieved but for the loss. So from there, now we have the loss of turnover. We need to convert loss of turnover to loss of gross profit because the policy covers the loss of gross profit, not the loss of turnover. And this is how we're going to look at the rate of gross profit. So the turnover of business is used to pay out the cost of running the business and generate a net profit. So the cost can in turn be divided between variable costs, which reduce in direct proportion to the deduction in turnover, such as raw materials, consumables, variable utility costs, transportation costs, packaging costs. And the second one is fixed costs, which must be paid even if the business is not operating, such as rental fee. So during the loss period, the turnover reduced and so does variable costs. So the insurer won't suffer any loss of under variable costs. And that's why a BI policy only needs to cover the insured net profit and fixed costs. The addition of net profit and fixed costs is called gross profit, which you can see in this yellow circle here. So when we try to calculate the rate of gross profit, right? So we start from turnover, which is 8 million. And variable cost here is 4.5 million. That means the gross profit is only 3.5 million. This gross profit, 3.5 million, consists of fixed cost plus net profit, the black and gray chunk here. So the rate of gross profit is calculated by dividing 3.5 million by the turnover, which is 8 million. And we now calculate the rate of gross profit of 43.75%. Maybe your next question is, how are we going to apply this one to the rate of, to this BI loss calculation? So you're going to apply this rate of gross profit to loss of turnover. So let's say you have the loss of turnover of $1 million. You're going to apply this 43.7% to the loss of turnover and calculate a loss of gross profit of 43.75 times 1 million, which is about $437,000 million dollars. Okay, let me give you more example of the rate of gross profit calculation. It's really important that we know how to categorize costs into variable or fixed. It might sound easy and simple, but when we come to a real case, it might be a bit difficult. And we always need to go back to the insurer to clarify if we are not so sure about the nature of the cost. So in this example, this is kind of a simple P&L. So we show you, we're gonna start from turnover, which is 150K. Then in this simple P&L, it shows the cost of sales, listing out all costs of sales, starting from raw material, power and fuel, production labor, factory overheads. And the total cost of sale is 77K. And the accounting gross profit, is derived by deducting turnover, deducting the total cost of sale from turnover, which is 73K. In other words, it's about 48.67%. And usually, if you follow accounting terminology, the insurer might stop here at 48%. But actually, we should still go down, through the P&L, even after the accounting gross profit line. So you can see that there are other selling expenses, which include advertising, sales commission, and freight. So sometimes when the insurer prepare the claim, they might just stop at the accounting gross profit line. They don't look further down. But for us, we always need to look through the whole P&L and identify which costs are variable. Because if you still remember, in the previous slide, I mentioned that variable costs are not covered. Because anyway, when the loss occurs, when there is a loss of turnover, the insurer doesn't need to incur any variable costs, right? Because variable cost varies with the revenue. So when there is no revenue, there is no variable cost incurred. But what we're looking for now is what are fixed costs and net profit. Because regardless of the incident, the insurer still need to pay out their fixed costs. And the net profit is the money that they're supposed to be able to put in their pocket. So now we are going through this, costs and then try to see which costs are variable. So I agree with the insured or, this accounting, simple P&L that raw materials should be considered as variable costs. Power and fuel as well. But sometimes, some portion might be fixed or variable. And based on the discussion with the insured, we think that only 5,000 is variable and another 2,000 is fixed. So I only put 5,000 here as variable. Production labor, I don't agree that labor is variable because, for example, if you need to hire someone to work for you, right? And no matter how many units of product you ask that person to produce for you, you still need to pay the same wages to that person. So if you pay $300, for that person, if this month he helped you to produce 300 units or 500 units, you still need to pay him the same amount of wages. So that's why I think of it as fixed, not variable. And factory overheads is usually a fixed cost. Then I don't stop there at the loss of, at the accounting gross profit line. I look further down and I could see that sales commission should also be considered as variable. Commissions usually varies with sales, right? If that person can help you sales more, then you pay them more commissions. Or freight. Freight depends on how many units of product you deliver to your customers. So this is all variable to sales. So when I look at insurance terminology, I deduct all these sales from the third column. So I consider raw material, power and fuel, sales commission, and freight as variable. and I deduct all these costs from the turnover. And now I get to the insurance gross profit line, which is 90,000. Or the rate of gross profit is now should be 60% rather than 48% if you only stop at accounting gross profit line. But I must stress that it doesn't mean that if we follow insurance terminology, we're going to arrive at a higher ROGP. This is for illustration purpose only, so it might be higher or lower. But the key message here is we always try to go through the whole P&L. Don't just stop at the gross profit line as indicated in the insured P&L, because there might be some other variable costs, further down, and that has to be taken into account when we calculate rate of gross profit. As I mentioned earlier, variable cost is not covered because it's going to be disappear anyway when the loss occurs, when there is no loss, when there is a loss of turnover. We only look at fixed cost and net profit. And bit less of gross profit of 60% include fixed cost plus net profit. It doesn't include the elements of variable cost, which is another 40%. Okay, so when we pay out the loss of gross profit, we compensate the insured at the normal level of fixed cost plus net profit. But what if the insured actually incur less fixed costs? Then we will have to deduct it from the loss of gross profit calculated. If we don't, the insured will benefit from this incident. But you might wonder, how can the insured achieve savings in fixed costs? Isn't it fixed costs always fixed? During normal course of business, they are supposed to be fixed. However, during the incident, some fixed costs might decrease. For example, rental fee. The insurer may manage to negotiate with the landlord to get some discount in its rental, since it cannot utilize the space during a loss period. Or the insured may achieve savings in daily repair and maintenance costs, as none of the machines are running. Hence, there is no need for daily repair. So we always need to think about whether the insurer actually achieved any saving in fixed costs during the loss period. But we will only be able to take credit of all these fixed cost savings only if the savings are due to the incident. If the insurer achieves some savings, but due to other unrelated reasons, then that doesn't count. For example, if the insured, pay less auditor fee during the loss period, it may have nothing to do with the loss, and therefore we shouldn't take into account these savings, because the insurer would have achieved, this reduction in fixed costs anyway, regardless of the incident. So it has nothing to do with the incident. Another component that we should look at is increased cost of working. Some people call it as AICLA or AICLA. So the insurer has duty to try to reduce and mitigate the loss during the loss period. So this cost has to be additional to the normal cost level. For example, if the insurer usually pay, OT for about $10,000 per month, we only look at the amount exceeding $10,000. So if it's still within or less than that, then it doesn't count as an increased cost of working. And for the cost to be considered as ICW, it must meet these three criteria in the box. So it must be necessary and reasonably incurred, and for the sole purpose of avoiding or diminishing the reduction in turnover. Last but not least, it has to be economic. I will give you an example of how the economic limit will be performed. But just want to give you an example of the mitigation measures that the insured might implement. For example, the temp equipment. So the insured may need to send its machine for repair for a few months, and in order to continue its production, it may want to rent a temp machine for them to continue producing that product and also supply to its customers. Or OT, overtime costs. So now that the insurer can run only a few machines, it may want its staff to work OT to maintain the normal level of production. Or outsourcing. This is one of the common practices. The insured can outsource its production to sister companies, which may be located within the same country or overseas. The relevant costs include increased production costs, because it usually costs less to produce internally, or increased freight costs, because this time they might need to use air freight instead of sea freight. So all these costs, it might be covered, and I will talk about this later, whether how we're going to look at an economic limit. And then in order to resume the production as soon as possible, the insurer may choose to pay extra money to expedite the repairs and replacement work. And this can shorten the indemnity period as the insured will manage to resume, the production and their normal profitability quicker. So now let's take a look at economic limit case. So if you still remember, one of the main criteria is economic. It makes sense, to pay $1 to save $1, but it won't make sense if the insured pay $5 to save $1. The insurance company would rather, the insured do nothing and compensate them at $1. So this is an example of how the economic limit works. So in this case, the loss of gross profit per unit is $50. So the economic limit is set at $50. Because if you manage to, save one unit, right? That means you can save the loss of gross profit of $50. Therefore, if you incur an increase in cost of working of $40 per unit, this is considered within the economic limit of $50 per unit, right? So the increase in cost of working going to be paid at full, which is for $40 per unit. So now the insurance company, is also happy that you mitigate the loss. So they only compensate you at $40, right? But what if you incur $70 per unit? This one now, exceed the economic limit, which is set at $50 per unit. So it will be we're gonna measure the increase in cost of working at $50, which is still within economic, but the remaining is not economic, and it will be covered only if you have an AICW or additional increase in cost of working coverage. Some policy doesn't cover this one, so always need to check back to the policy. So to sum for this one, if you don't have any AICW coverage, the policy will only pay you at $50. But if you have, then the extra $20 will be covered as well. So always try to look back at this economic limit case, because sometimes the insured might, spend more than this $50 to save the loss of gross profit at $50 only. Then the reason for that is sometimes, they just want to, try to get the products, to their customer as soon as possible, regardless of the cost that they have to spend. They want to maintain the, customer relationships. And by doing that, they might need to incur more than this economic limit. So if the insured think they might need to incur more, in during the loss period, it might be good for them to considering, paying the extra premium for this AICW coverage. And the next one that I would like to talk about is the average. So this is the graph that I would like to use it to explain to you how it works. So Jan 16, this is the policy inception. But of course, you're gonna renew your policy before the date of inception, right? So October 15th, this is when the insurer wants to renew the policy. At that point of time, it didn't have the full year 2015 financial statement to refer to. So it could only go back to 2014 financial statement, which shows an average of 220K. This is significantly less than gross profit earned, on the policy inception date. So the insured might want to set their gross profit at this rate, at 220K. And if you can see, not so sure whether you can see my cursor, but you can see that it's actually about, 3 times lower than the gross profit that the insured is supposed to earn on the policy inception date. And in this case, the incident took place on 31st December 16. So the sum at risk, which will be compared to the sum insured, is equal to the total gross profit achieved from the date of loss until the maximum indemnity period. And in this case, I assume it to be 12 months. So you can see that the average of this one is about 800K. So you set your sum insured at 220K based on 2014 financial statement. And when the loss occurs, the level of gross profit is about 800K. And this is about 4 times higher than your sum insured. So this results in serious underinsurance, and the amount payable will be proportionately reduced. Like in this case, if I calculate the loss, of gross profit, for this insured for $1 million, and this, and because of this, there is an underinsurance issue, and only 25% of total loss will be covered only. So we will pay out only 250K to the insured. So this is really important that the insured set that sum insured correctly, because if not, right, the measure loss will be reduced a lot. And in this case, it might be, we might pay them only 25% of their total loss. And definitely this one, gonna cause a lot of argument with the insured, because to them, they also would like to, be compensated at 100% of their total loss, right? But because the sum insured that, that is indicated in the policy is only 25% of the loss of the gross profit that they're supposed to earn during, the period of date of loss until the maximum indemnity period, then we cannot pay out 100% of total loss. We actually come across with this issue quite a lot, during the Thai flood and other catastrophe loss as well, because this is when the insurer realized that actually the sum insured that they put in their policy is not sufficient. Because sometimes, when they renew the policy, they don't actually change they don't actually revise the sum insured. They will just, continue renewing the policy using the same, sum insured figure, which is not correct, because, anything can happen, right, in the future. And here, that's why I put here, when you put the, it's important that when the insurer renew the sum insured, this process is a forward-looking process. If we rely on historic accounts, we don't take into account any change in business or new strategic plans, which may help increase the business turnover. For example, if the business, right, if the insured plan to enter into the new market, for example, definitely the turnover will increase, significantly afterwards, right? So if they stick to the old sum insured figures without taking into account all the plan, in the future, definitely the sum insured will not be sufficient. And they will only realize about this when the loss occur, and they can't, and all the loss cannot be paid at 100%. So, and one more key point that you need to, maybe you want to take note is, as the sum at risk is calculated from the date of loss until the end of indemnity period. When we set the sum insured, the insured, right, should, anticipate what the gross profit will be in the future. So if the indemnity period is 12 months, like in this case, we need to forecast gross profit for the next 24 months, as the date of loss might be the last day of policy period, right? So if you go back to this chart, right, in this case, I just, this one is like the worst case scenario, which is the last day of the policy period on 31st December. So when the loss occur on 31st December 16, the sum at risk, which is, which we're going to compare that against the sum insured, start from the date of loss and to the next 12 months. It doesn't start from Jan 16. It starts from 31st December 16 until 31st December 17. This is one of the misconceptions, actually, because sometimes when the insurer set up their sum insured, right, they thought it's gonna start and end, from the start of insurance period until the end of insurance period. But actually, it's not the case. When we assess whether the sum insured is sufficient or not, we look at the sum at risk or gross profit, projected gross profit, starting from the date of loss until the next 12 months, or whatever month it is for your maximum indemnity period. But in this case, it's 12 months. Yeah, so how will gross profit change from a policy inception to the end, of potential maximum indemnity period loss? This is very important when the insurer try to set up the sum insured. And always ensure that all variable costs are excluded. If it's included in the sum insured, it will be excluded from the loss calculation anyway, as the insurer doesn't suffer any loss of variable costs. Actually, one of the power plant losses that I work on actually include its main raw material cost in the sum insured. Of course, after the loss occurred, right, the insurer couldn't generate power and thus didn't need to consume fuel for a few months, meaning no loss of variable cost sustained. The insurer only realized about this sum insured issue after the loss happens. And we were, after the loss happened, and we were engaged to measure the loss, and we identify this issue to them. That's how they realized. So it has, so it wastes that premium for several years before the loss occurred. It's quite it's quite surprising for us as well, because sometimes I can understand, like sometimes they miss out some variable costs, right? They might mistakenly include some variable costs to the sum insured. But in this case, this raw material accounts for about 80% of the total loss. And you can imagine that, the premium that they waste is quite a lot. And the next point is you can exclude fixed costs only if it's understood that it's not going to be paid in the event of a loss. So some business, right, may want to exclude some fixed costs, which they think they can definitely save it during a loss period. For example, if they have an agreement with the landlord, that if anything happens to the premise, the landlord will not charge rental fee until it can utilize the space again. So they know that, they definitely can save this amount. So the insured can then choose not to insure rental fee in the policy, because if they choose to insure, right, it's going to be included in their sum insured, and the premium, is based on the sum insured. And if the loss occur, we are not going to pay them for this, rental fee anyway, because the insured will manage to save the total rental fee. So there is no point to waste that premium. But of course, must always make sure that this cost will be safe. If it's not and the loss occur, we will not pay out this, this rental fee. So it's important that, all these elements are considered carefully when the insurer set up their sum insured. And this one, I would like to give you a simple BI loss calculation. So now you can kind of know how we're going to apply the theory that I mentioned earlier to this, to this case study example. So in this case, right, for this insured, they manufacture fridges, and the production, they produce and sell 120,000 units, in the 12-month pre-loss. So the monthly sale, it's about 100K. Assuming that the loss occur on 1st Jan, and the policies indicates 12-month maximum indemnity period, the insured in this case had to shut down for 6 months, and there could resume the production afterwards. And in this case, the manufacturing cost, per unit is $30 for raw material, $10 for utility costs, and $20 for logistics. All these costs should be considered as variable costs. And the total variable cost here is $60 then. And if you go back to the first bullet point, you can see that the selling price per unit is $100 because you sell 12,000 units. For the amount of $1.2 million, right? That means the selling price is $100 per unit. And if you still remember how we calculate the rate of gross profit, right? We start from selling price minus variable cost. So in here is 100 minus 60 equates to $40. So your rate of gross profit is 40%. And there are more points to take note here. So the monthly rent is 16,000. And the insurer managed to negotiate with the landlord and, with the landlord, and this is reduced to 4,000 only. So in each month, they managed to save 4,000, and the total is 24,000 for 6 month loss period. And they also managed to save, some wages. And in this case, right, they managed to reduce it from 10,000 to 8,000 per month. That's mean they managed to save about 2,000 per month. And in total, 12,000 for 6 months. We're going to bring all this information into the calculation worksheet in here. So you can see that the standard turnover for each month is 10,000. This is just to make, this calculation simple and easy. But if you still remember what I mentioned earlier about standard turnover and other circumstance clauses, it might not be as easy as looking back, to 12-month pre-loss turnover. You might need to consider other factors, for example, any new production lines, any new customers, or is there any new competitors in the market which might impact your, pre-loss turnover level? If that's the case, then we might not be able to just, adopt 12-month pre-loss figures as we are doing here. And in this case, we just assume that they achieve no actual turnover in the loss period. So the loss of turnover is calculated by, deducting actual turnover from standard turnover, which is 100K for each month from Jan to June 18. And the rate of gross profit is calculated as 40%, right? Because your variable cost is 60%, your sales is $100. So 100 minus 60 is $40 for gross profit. And the rate of gross profit is calculated by dividing 40, which is gross profit, by your sales, which is 100. And that's how you arrive at $40%. So here you multiply the rate of gross profit with the loss of turnover. That's how you calculate the loss of gross profit of 40,000 per month from Jan to June 18. Then the total loss of gross profit year is 240,000 for 6-month loss period. And we also need to take into account, fixed cost saving here, because the insurer managed to negotiate with the landlords, to get some discount in its rental fee. And the insurer also, can reduce some of the wages fee. Sometimes the insurer might decide to, fire some of their staff, because especially if the interruption period is quite long, if it's a short one, then there's no point for them, to fire their employee and then, still need to recruit a new batch, right? But in this case, because they shut down for 6 months, they might want to, fire some of their staff. And of course, still need to retain some of their staff. And in this case, they managed to save about 2,000 per month for wages and 12,000 for rental fee. So the total fixed cost saving per month is 14,000. And when we deduct, savings from loss of gross profit for each month, we arrive at a total loss of about 26,000. And in total for the 6-month interruption period, we calculate the loss of, gross profit of 156,000. And this is before we consider about any under insurance issue. So if there is no under insurance issue, we're gonna pay out at 100% of total loss, which is 156,000. But if we assess the sum insured, whether it's adequate or not, and it shows that the sum insured is not adequate, for example, if it's only 80% adequate, we're gonna apply, multiply that 80%, 256,000. And, the amount we calculate is gonna be the one that we're gonna pay to the insured. So the insured will not be compensated at 100% of total loss or 156, it's gonna be compensated at 80% of 156,000 only. So it's really important that, the sum insured is set correctly. And another element that I would like to mention is about deductible, which is not, taken into account here. Deductible is usually indicated in the policy is the period that, the insured, for any losses that the insured sustain, be covered by the policy. For example, if deductible, is stated to be 2 months, for example, it might be, it also might raise a question whether it's supposed to be the first 2 months or the average 2 months. If it's the first 2 months, it's easy. That means, whatever loss occur in Jan and Feb will not be covered. But if it's, an average of 2 months, then we're gonna, average it out for the whole 6-month loss period. But here it's easy because each month, the loss amount is the same. But if it's not the same, then we need to do, 6 months and then 2 months out of 6 month average. And sometimes it's not very common, but sometimes the policy might say the fixed amount of, let's say, $5,000 is not covered. But I don't see it quite often. Usually it's for PD, property damage policy. Usually for BI policy, it will indicate as, a number of days. But sometimes the policy is not clear whether it should be the first XX months or the average, month. So it's always, sometimes it's good, if the policy indicate it clearly, because if not, it might raise some issues when the loss occur. Because of course, right, the insured might also want us to deduct, as but for insurance company, it might be more, appropriate. If in this case, it's not going to be an issue because the loss each month is the same. But if the loss in each month is different, it's going to be an issue, right? Because if the loss for the first few months is huge, right, the insurer might not want us to deduct their loss during the first few months. They might want us to use that, average month instead. And on the other hand, if the loss in the later month is huge, rather than the first few months, then, the insurer might want us to, adopt the deductible as the waiting period or the first few months. So that it might cause, some argument. And the best thing is the policy should indicate it clearly so there is no question or argument after the loss occur. Okay. So this brings me to the end of presentation. But of course, we welcome, any questions from you guys. So now I will, so Pupa, are there any questions from the audience?
Yeah. Okay. Thanks for that, Nay, for the presentation. Now we will, if you can remove your slide, then we will put my other slide first. You can end your...
I stop sharing, okay?
Yes, please. Yeah, you can stop share, and then I will now do my share. Okay, ladies and gentlemen, if there are any questions from the floor, please, can you see the slide now?
Yes.
You can see the slide, right? Mm-hmm. Okay, there's a question from David. David Fernando has asked a question on explanation for deductible and how we apply average or deduct the first or second month. Maybe we ask David to say hello to us. David, you want to come to the mic? David, you want to open the mic, unmute yourself and come to the mic? David?
Hi, David.
Hello.
Hi, David. You want to introduce yourself? Where are you from?
I'm from Indonesia, from Cunningham, Lindsay, Indonesia.
Apa kabar di Indonesia?
Baik, baik.
Okay. Please address your question again so that Miss Nay can try and give you a better answer.
No, sometimes it's very I'm curious about the applying a deductible, as you said before. Sometimes we confuse what the best. If there is no explanation, we use average, as you say, or we just deduct. For example, if there is a deductible 2 months, so we just deduct first and second month. What is the best?
Actually, okay, I think this is the policy interpretation issue because I mean, forensic accountant, we don't interpret the the policy, but of course we need to actually refer back to you, like what do you think about this one? Because if the policy is not clear, I mean, forensic accountant, for us, we also can't help you decide what is supposed to be, because what we can do is sometimes we might say, okay, if if we apply the average, I mean, let's say if we apply the first few months, this is going to be the deductible amount. And what if we apply it as an average daily loss? This is going to be the amount of it. But we can't make a decision on your behalf because we also don't know the intention when the policy, is incepted, right? So we need to always get back to you.
Okay. Yeah. Okay. Thank you. Okay.
All right. Thank you, Pa David, for the call, and Miss Nay, thanks for addressing that. Do we have any more questions? I have a question for you, Nay. How do you deal with situations when you're dealing with a claim and the insured may come along with one of their accountants? They may maybe with Pricewaterhouse accountant or one of the chartered accountants coming with their view on the calculations. So what are the challenges there and how do you deal with that? Nay, can you tell us?
Actually, because I used to work for Big Four.
Okay. Yeah.
Right. Yeah. But then, okay. But based on my experience now that I work with NDD, right? So there are actually, there might be quite a lot of arguments. But let me give you an example. Like sometimes they might argue about the, projected turnover, for example. Because sometimes the claim might just want to simply adopt 12-month free loss. If you look at the policy wording, it says you need to look at 12-month free loss. Yeah, and they ignore about the other circumstance clauses. So it might be the case, but for us, definitely we might want to analyze, the year-on-year growth, trend, consider seasonality, include days with low production as well. But sometimes, the claim preparer might say, why do we include the, the low production level days? But to us, right, regardless of the loss, there might be some days that you don't produce a lot, you don't sell a lot. So we still need to take those into account. Or sometimes even the ICW, increased cost of working, it's not really a dispute, but sometimes we spot something in the claim, because sometimes the claim also ignore the normal level of cost. As I mentioned during the ICW slide, right, we always look at the normal, the cost that's beyond the normal cost level. So sometimes the claim ignore that part, or they even ignore the economic limit. Okay. Because they just submit, whatever increased cost they think the insured actually pay out. I mean, but all this, right? But sometimes I think it's good, as in after we explain to the claim preparer, they usually understand the concept that this is what we what we want to do, and they will communicate that with the insured.
Okay. Yeah. Okay. Thank you, Nay, for the clarification. We have a question from Mr. Eugene Ang. He asked a question: how if the interruption is more than 6 months, but the raw material will expire in 3 months if they are not used. What kind of cost will be considered as business interruption? Maybe I ask Eugene to come online. Eugene, you are able to come online to introduce yourself and also share the question again. Eugene?
Hi, thank you, Puba. Can you hear me?
Yes, I can.
Okay, so my name is Eugene. I'm coming from corporate Singapore. So
Yes.
my question is just because a lot of time, let's say food manufacturing, the business interruptions can be more than 6 months, but then they already have some raw material, let's say milk, eggs, this kind of thing. They cannot store for too long, but because their machine is down or whatever happened, that they cannot do the productions. So all this raw material will kind of be expired or will be exceeding their expiry dates. So there will be a cost that's and considered as a loss to the insured. But are we taking that into account in the claim payment?
Well, I would say, I think I got some echo, right? Or background noise.
Wait, hold on. Let me switch off the mic first, then you come in again. Hold on. I'm going to mute all now. And
yeah, I come in.
Yeah, please come in. Okay.
Okay. So I think in this case, right, because eggs, right, supposed to be considered as variable cost, right? Because they use it in, for example, to produce some kind of food, right? Oh, I think Puba, can you help unmute again? It's really
Oh, it's coming in. Okay, hold on. Mute all again. Okay, yes, done.
okay. So I think in this case, right, it's kind of like because we need to think first when the insured set up the Sum Insured, right? If they actually deduct this from that Sum Insured, from the turnover, because if they consider it at variable cost, right, they definitely deduct that from the turnover to come up with that gross profit, or the amount of money that they want to put as a Sum Insured, right? So if they already deduct that from the gross profit, then definitely it's not part of the BI because it's not there. But of course, I mean, this is a very good question. So what if, because in this case, all the eggs or the raw material or the ingredients, right? Because of this. And I would say this is also not part of the stock loss because it's not damaged, because of the incident. But some people might look at this as an increase in variable costs. This is one of the topics that is quite complicated because there might, in this case, that's mean if you want to average out all your raw material costs, right? Then that's mean your raw material cost is going to be higher during the loss period. If you want to take into account, all the money that you pay for eggs, right? And now you want to put everything under your cost of sales when, after you come back to normal operation. But this topic is really complicated as in increasing cost of variable cost is usually not covered if you don't have the AICW coverage. But it might be argued sometimes by the insured that, but what if I don't incur this at all? So how am I gonna, continue the production? So I think now it's also come to the negotiation, between the insured and the insurer as well. But it's not just about, it's not about only the, food manufacturer. Sometimes there might also be, be an increase in other variable costs, in other industry as well. And I always ask them, so what is about the economic limit? Do you think it's going to be within the economic limit or not? And if not, it might have to be under AICW. And again, you need to check whether the policy has a AICW coverage or not. Okay. But it's a very good question.
Thank you, Nay, for that clarification. I just want to mention that in the audience today we have our friends who come from very far away in Mauritius. Can I invite Mr. Ashfaq to say hello? Mr. Ashfaq, are you there? Are you able to say hello to us? Mr. Ashfaq, are you able to say hello from Mauritius? Ashfaq, are you there? Okay, I can't hear Ashfaq to say hello. Can I then ask, I have a friend from India, from Mumbai. There is Miss Dr. Anisha. Dr. Anisha from Inches Academy.
Yeah, hello everyone. This is Dr. Anisha from Inches Academy. As
how are you today? How are you today?
I'm doing good. How are you?
Okay, thank you for joining us all the way from India. You're in Mumbai, right?
Yeah, and a very good session, very good session.
Yeah, thank you for the support on this program organized by AICLA. Do you have any specific questions to ask our guest speaker, Miss Nay from MDD Forensic Accountants in Singapore?
No, I think she covered it all. She was brilliant with whatever she taught and it was very clear. So thank you, Miss Nay, for giving us such a nice session and so insightful. Thank you.
Thank you, Dr. Anisha. Okay, that's Dr. Anisha. And then is Mr. Ashfaq there? Ashfaq from Mauritius? Ashfaq, are you there? Okay, we're not getting Ashfaq. We have another question coming from Ma. Ma is saying that what if during underwriting stage, the insured did not submit the breakdown of the business interruption sum insured? He just gave a lump sum insured. But when a loss occurred, it will then be open to dispute and also the issue of moral hazard. So maybe we can ask Ma to come to the mic. Ma, are you able to open the mic, unmute yourself and say hello to us? Introduce yourself.
Hi, good afternoon, Puba. Mahindran here from Hanover, KL.
This is not, I didn't know it's Ma. Okay. How are you?
I'm good.
Okay,
how are you?
Okay, thank you. Please repeat your question again.
Sure.
Hanover, Kuala Lumpur.
Yeah. Yes, that's right. Thanks, Ms. Nay, for the sharing. So very insightful. I'm an underwriter here, so my question is related more on underwriting, actually. During the underwriting stage, when we get a proposal from insureds, we usually ask for a breakdown of sum insured for the BI. How much is the gross profit? How much is ICAO and such? But there are times when they do not submit. But then when the loss occurs, there's always open to disputes. And then I'm sure accountants, when you go in, you would ask for the books, P&L and such. But again, it could be open to moral hazard. I mean, they could be creative and come up with their own figures, right? Because it's not declared during the underwriting stage. So how do you handle this, actually?
I think your question is about the dispute regarding, the type of cost, right? Whether it should be variable or fixed. Is that your question?
Yeah, something like that, which is not declared during the proposal stage or underwriting stage.
Yeah, actually, most of the time, I also don't get the sum insured spreadsheet as well, because I understand that, at least, most of the cases that I handle, right? The insurer didn't submit the, the BI spreadsheet, the breakdown that you mentioned to, to the insurance company when they purchase the policy, right? So, but we still need to stick to the insurance terminology that I mentioned in one of the slides, right? That I try to compare according terminology with insurance. So we still stick to, to the concept. Like I definitely will go through the, the P&L and try to, identify whether this one should be variable or fixed. Then of course, if, the insurer doesn't agree with this, we will need to sit down with the insured and go to it. Sometimes because they might identify, they might categorize it differently because they don't really understand the insurance concept. But I still play by the rule. So if I think it's fixed, it doesn't vary with the turnover. It has to be like that. So, but again, we still need to check that against the sum insured, whether it's adequate or not.
Yeah. Okay,
sure. Thanks, Ms. Nay. Thanks, Puba.
Thanks for joining us on this, Mahindran.
Thank you.
Can I invite Mr. Hazwan from Sterling Insurance Brokers in Kuala Lumpur? Mr. Hazwan? Hazwan, are you there? Hazwan?
Hello, Puba.
Yeah, Hazwan, good evening, and how are you?
Good evening. Sorry, apologies. I'm on the move, actually. I've been listening to my mobile.
Oh, okay. So do you have any questions to ask our guest speaker, Ms. Nay from MDD?
Yeah, I posted a question. Let me see. Okay. In regards to the variable cost, okay, what if the variable cost is actually be made fixed cost by way of an agreement with, let's say, the raw material supplier. Let's say they have an agreement with the supplier. This for this whole 1 year, we agreed to buy this raw materials from you for this whole year. But then when the loss occurred, they still have to purchase this raw materials as per in the agreement. So can this variable cost be considered as fixed cost instead? Thank you.
Thanks, Haswan. Nay, you want to tackle this?
Okay, thanks, Haswan, for the good question here. I think it depends on whether, like in this case, right? So there's a fixed agreement between supplier and the insured. But I think I also experienced this kind of issue before. But one of the questions that we always ask back to the insured is, so what are you going to do with these raw materials? Are you going to use this for the future, or you will not take it at all from the supplier? As in, like, maybe you take it, you throw it away, or you will not even like take it from the supplier. Right, so that's the question, because definitely if you still need to pay and you can't take it at all, as in like you can't use it for for your future consumption of production, yeah, this one sounds to me like it's a fixed cost. It doesn't mean whatever I mentioned earlier, like for example labor, it has to always be fixed. Like labor, for example, right, it can also be variable. Like especially I think in US, for example, sometimes they pay wages based on the number of the unit of products that staff produce. So that one should be considered as variable. But I would say that most of the time labor is fixed, because you don't actually check the number of units that staff help you produce, right? So that one can be considered as fixed for most of the time. So that's why I think it's very important, whenever we receive the P&L, we always go through it. We might want to categorize first whether it's variable or fixed. But if the insured thinks differently, we need to talk to the insured and try to understand their business. Yeah, and that's how because if not, right, I mean, I also don't know their business. It's the insured who understand the business the best, right? So always get back to the insured and try to understand the nature of each cost if you think it's not clear.
Okay. Thank you, Nay, for the clarification. We have a question here from Noor Muhammad. Noor Muhammad says that in the definition of gross profit in the policy, there's a clause due provision being made for depreciation. Can you elaborate this, whether depreciation should be considered or not in the gross profit calculations? Can I invite Noor Muhammad to say a few words? Noor Muhammad, can you join us, unmute yourself and say hello to the audience?
Hello.
Hi.
I'm Noor Muhammad.
Where are you from?
I am from Pakistan.
From Pakistan. Welcome to the
Pakistan.
Welcome to the class. Which company are you from?
I am at Hamid Majid Associates.
Hamid
Majid Associates.
Yes.
Yeah, we have done a couple of assignments with MDD here in Pakistan for forensic accountants with Daniel Thorpe. Daniel Thorpe from Dubai.
Yes, Dubai.
Okay. Actually, we have a problem here that in calculating the GP, there is a clause that due provision being made for depreciation.
Okay.
This is confusing whether depreciation should be included or excluded in calculation the GP rate.
Okay, so, I mean, for this wording, I never see this specific wording before, but I would just, because this is about policy interpretation, so which I can't really answer, on behalf of insurers, right? But I would answer your questions whether about depreciation, right? Whether it should be considered or not in GP, for example, right? So usually depreciation is considered as fixed, right? Because it's definitely not variable, unless again, sometimes the insured might want to depreciate their machine, for example, depends on the number of units that they produce from that machine, and in that case, it's variable. But I think most of the time they might just do the straight line basis, which mean like they just, let's say they purchase 1 million, right, for the machine. They think it can be used for 10 years, so they will just depreciate 100K per year. So in that case, it's fixed cost. Yeah.
Okay.
Thank you.
Okay. Mr. Noor Muhammad, how is Mr. Mahmood?
Mahmood is okay. He's Hamid Mukhtar.
Pardon, he's?
Yeah, he's in Hamid Mukhtar, yeah.
Oh, Hamid Mukhtar. Yourself?
Hamid, yeah. We have associated with Mr. Mahmood for forensic assignments in Pakistan.
Oh, okay. All right.
Yeah.
Okay. All right. Thank you for the question.
Thank you.
Do we have any more questions from anybody else? Can I invite Pak Budi Maharesi, who's our council member for AICLA, who's based in Jakarta, to come on the line? Pak Budi Maharesi?
Hi, everybody.
Hi. You want to say a few words? Any questions for the guest speaker?
No, I think Nat has been explaining quite good. I personally have worked with her for a couple of works, so I'll give a chance for the other audience to ask questions.
Okay, thank you.
She's a very valuable resources.
Thank you. Thank you, Pak Budi. Thank you, Pak Budi.
Hi. Sawadee
I don't know whether our other friend from Jakarta, who is also online, want to say a few words. Regina from Sedgwick in Jakarta, you want to say a few words? You want to have any questions to ask? Regina? Regina, you want to unmute yourself and speak to the speaker? Regina is not coming. And Ashfaq, are you able to talk to us on the mic now? Ashfaq from Mauritius? No.
Hello, Kuba.
Yeah, hi, who's this?
I'm Regina.
Hi, Regina. Good evening, and how are you in Jakarta?
All good, but yeah. I'm not in Jakarta because our office still not normally open.
Okay, so where are you now?
I'm in my hometown in Pekanbaru, Riau.
Oh, in Sumatra?
Yes, you know it.
Yeah, I know in Sumatra, yeah. So you have any questions to ask our guest speaker, Miss Ne from MDD?
Oh, no, all good. Miss Ne's excellent presentations, okay. I think. Yeah. Just waiting the paper to be shared to our friends in Cunningham, Jakarta.
We will share the slides with all the participants after the course. Thank you for joining. Miss Ne, Regina is also a loss adjuster. She's a chartered loss adjuster working for Sedgwick in Jakarta, but she's more specialized in liability losses. But she also does BI. You do BI as well, right?
Yep. Just a bit.
Okay, thank you. Thank you, Regina. Have a good day.
Yeah, Miss Ne. Yeah, Kuba.
Thank you. Do you have any more questions from anybody on the floor? If there is any more questions from anybody else? If there's no questions, then I would like to invite everybody to... Is there any more questions? If there are no more questions, yes.
Kuba, maybe last question if anybody. Just a classic case, Nat. Normally, when you do a repair, some of the insured take the opportunity to do an overhaul as well. So this is I think there are a lot of case occurred within this scenario. If the overhaul time is actually shorter than the repair time, that would be no problem. But what about if the repair time actually shorter than the overhaul time?
Okay. When you say overhaul, you mean like the plant maintenance, right?
Correct.
Actually, even though it's shorter, let's say they need to repair for 3 months, but the plant maintenance is 1 month, right? Just give an easy example. So let's say the plant maintenance, is carried out during that 3 months, loss period. Then we need to take credit for that one, because let's say they're supposed to perform, this plant maintenance 2 or 3 months. It's okay. Let's do like this. So the loss period is from Jan 2020 to March 2020. And but for the loss, they're supposed to carry out the plant maintenance in May 2020. But because of this, right, they bring it forward to be done during the 3-month loss period. So in this case, we need to take credit, because after they resume the production, they don't need to shut down again to perform the plant maintenance. So we need to take credit of that 1 month from the whole, loss calculation. But if the plant maintenance is for 4 months, but you only shut down for 3 months, that means the whole loss cannot be covered.
Mm-hmm.
Yeah, because they take this opportunity to carry out the plant maintenance. That means in the future, they don't need to shut down anymore, right? So they wouldn't, they wouldn't like sustain any loss of profit in the future, but they actually supposed to, sustain some, right? If they shut down for plant maintenance. Yeah.
Okay.
Okay.
I hope that answered your question.
Yeah. Pak Budi, are you okay with the
clarification? Yeah.
Okay.
Okay. I shall attract that scenario for the audience.
Okay. Thank you, Pak Budi. I just realized that our another council member who looks after Myanmar is here with us, Mr. Harold. Mr. Harold is also our council member for AICLA. Maybe Mr. Harold, you want to say a few words to the audience? You're going to unmute yourself first. Unmute yourself.
Yes, Uba.
Yeah, hi.
Hi, yeah, good evening to everybody. Yeah.
Sawadee Harold.
Yeah, hi.
Hi.
Do you have any questions to ask us?
But no question, because we are quite close with the MDD Thailand. Right? Okay, we worked together in the past. Yeah.
With Burima.
Yeah, right. Hong.
Yes. Yes.
And also Dan
De Silva.
Yeah, Dan De Silva, he left MDT already.
Yeah, he's become a loss adjuster in Australia.
Yeah, right. Yeah, okay.
Yes. Okay. Very good, Harold. Thank you.
Yeah, okay.
Can I also invite our friend from Swiss Re, Pak dkhairat, who is a Swiss Re Takaful. He is helping us today with the dkhairatTV live streaming. So maybe Pak Delil has got some comment or some question to ask our guest speaker. Pak Delil? Okay. Okay. Thank you. Thank you very much. Thank you very much. So thanks. Is there any more comments? If no more questions, I'd like to open ask everybody to switch on the video so that we can take a group photograph to record the audience who attended today's session. So can I ask all of you to switch on your video? Then we can take a group photograph for a record of the event. Yeah, there are many of you here today, so I may have to do two photography one at a time. So please come on, switch on the video. Maybe the ladies need to put on the makeup and so on. Gentlemen, not necessary. Then we'll take a group photograph. Okay. Everybody can put on the video. Please put on the video. We'll give you a few minutes to switch on the video and we'll take a group photograph. As we conclude the matter, we like to say thank you again to MDD for Ms. Day for supporting and providing the resource for today's talk. And also all the participants who came. Not to forget, we have our supporters or promoters of the event, Malaysian Insurance Institute. Then there's also our AMLA, Association of Malaysian Loss Adjusters, SII in Singapore, of which Ne is the treasurer. So they also help with publicity. And then we also have the GIA from Singapore supporting and promoting the event. So now I think everybody got their mic on. So I will take two photographs, one in this group, one in the other group. Don't worry about the message, Ne. So let's all smile. Everybody got to smile. And maybe give a thumbs up for Ne. Give a thumbs up for Ne for the presentation. And I'm going to take a photograph. Wait, two photographs. Smile, yeah? All smile. Okay, that's one. Now I got to go to the other group to take another one. Yeah, this is the other group. Can I also have a smile here? A big smile from everybody. Donald and so on. Yeah, thank you. Got it. Okay. All right. Thank you very much to all of you who took time to join this event. Thank you very much for the participants who raised questions. David, Eugene, Mahindran, Dr. Anisha, Haswan, Noor Muhammad from Pakistan. And with that, thanks again to Nay for taking time to share technical knowledge of the subject. So AICLA is the Association of Chartered Loss Adjuster. We have based in Australia, but we have committees formed in Singapore, Malaysia, and also all the other regions as well. So watch out for the next event. We will keep you updated and we will call you for the event. Okay, guys, with that, thank you and goodbye, everybody.
Bye.
Bye. Thank you.
Bye. Bye.
Bye, Pak Delil.
Everyone, good evening.
Bye, everyone. Good presentation, Puban.
Thank you. Thank you, guys.
Thank you. Thank you.
Thank you.
Bye.
Thank
Thank you, Dee.
Thank you.
Thank you, Dee.
Thank you, everyone.
Thank you. Bye.
Bye.